Well, thanks for everyone that has joined the call this morning. I appreciate everyone joining, and as if you were on earlier, you know that technology maybe not be my strength, but I'm here and we're getting this done. So I know that everyone has received the package from Kim. Obviously, if you're here, you had the login information to join this call. And today we are going to review the recent performance of the Vermont Community Foundation investments and talk a little bit about the current environment. And with that, I'm going to turn it over to Mike Miller. And just as a reminder, we're asking everyone to mute their lines while Mike is presenting. But as you know, Mike will pause and ask for questions. Feel free to raise your hand if you have a question before Mike asks for questions. And then, of course, at the end of the meeting, we will always open it up for questions as well. So with that, Mike, I am going to turn it over to you and let you take it away.
Okay, great. Thanks, Deb, and good morning, all. Really nice to see you all. I have a very nice report to deliver today, although I always have to introduce something just to think about and be maybe worried about. So just because we're never happy here at Crucial. Vermont Community Foundation is more a happy place. But I'm going to share my screen, and I won't necessarily be able to see you all if you raise your hand. So if you do want to just jump in with a question, I will pause, as Debbie said, and you can also throw a chat in there if you don't mind. Even just saying, "Hey, I've got a question," and I'll see the chat usually pops up, and then I can at least breathe for a minute and see what happens after that. So let's see here. So hopefully everyone can see this. Yes, we're good. Perfect. So let me start with a couple of big picture comments, and we'll talk about this performance slide and some of the others. And as Debbie said, we'll also talk about what we're thinking about, what's going on in the markets, and what we think will happen or potentially happen on a long-term basis going forward. And as also, as usual, a reminder of the strategy that's being employed. So a couple things, I've been doing this now for 35 years. And one of the things I've learned over that time is that there's different skills or qualities you need as an investor at different points in time. And we've just been through a time where the skill you needed was essentially a very high EQ and a very calm demeanor and a willingness to stick to long-term thinking when it's very hard to do it, frankly. Frankly, I hope never again will any of us experience, at least from an investment perspective, a more difficult time to think long-term. There was every reason not to. But that skill set is enormously valuable. And we talk about the returns in a minute. You can see that the Vermont Community Foundation clearly exhibited that skill. Dan, Debbie, the investment committee. The good thing about this one, I have to tell you, is there was never any doubt. Having sat through lots of meetings through the course of 2020 with them and into 2021, which has been less stressful. Like I said, there was never any doubt. So the good news is these returns are great, as you can see. The bad news, which I'm not going to talk about till a little bit later, is that there's another test coming, and it's a more difficult test, frankly. Not difficult in terms of our lives and the challenges we've all faced, but more difficult in terms of it's a more insidious thing. The risks of 2020 were very much a punch in the face, proverbially. The risks of 2021 to 2031, and not this year, are a little more difficult in the sense of what they can do and the damage they can do. Again, that's the problem, is hidden enemies are much more dangerous sometimes than the ones that are right in front of you. So we'll talk about that a little later. So sorry for that totally downer comment, but I think it's important. And it's also important because there's an answer to what to do about it. And so that's why we bring it up when we think about these things. So with that said, these are the returns of the three pools. And as you can see, we compare each of them to a custom benchmark, which reflects the asset mix of those pools. We'll talk a bit later about other types of benchmarks that can be used. And you can see here that the long-term pool so far this year is up 7.2%. It's actually now up close to 8.6% year to date. So things are continuing to be good there. I've highlighted the March 31, 2020 numbers. So that's the post-pandemic, as far as the market was concerned. We actually realized there's a pandemic going on, although I was very impressed. I saw this morning Vermont is leading the nation in vaccinations. I saw this morning, which is fantastic, of course. And you can see, though, that the portfolio has generated 41.1% return. This is net of investment fees, which is well above the benchmark. You can see that period in the middle, which is getting better, but still not one makes us happy, which is the 3-year number where we're behind the benchmark. 5 years, we've inched back above the benchmark, and then 10, 15. And since we started with the foundation in 2002, returns are well above the benchmark. And we're very optimistic that we're heading back to those kinds of numbers over the periods of time that we're all going to keep looking at. CPI plus 5, which is going to come up again later, is the actual long-term goal here, right? Which is let's preserve the purchasing power of endowment or long-term assets so that, you know, today the community and the things and the causes you care about have demands and needs. 20 years from now, that'll still be the case. It might not be all of us exactly, might not be the exact same organizations, but this capital needs to grow. It needs to grow to support future generations as much as it does the current generation. Then this SR, the socially responsible pool, is underneath. And you can see here, this pool, which we'll talk about the two pools and the differences a little bit later. But this pool was, if you went back 3 years ago, people were asking why didn't it do as well as the long-term pool? And now today you get the exact opposite question. And so there's a lot of cyclicality here is what I would like to say. And I will tell you that both pools, as you can see, have outperformed their benchmarks over the longer period of times, the socially responsible pool actually over the shorter periods of time as well. And so both are really well managed pools. And I think the one you choose for your funds is very much about how you are aligned with the values and the objectives and the construction of each pool. So I think it's very much an individualistic thing. It's not that one is better than the other per se. And then the midterm pool at the bottom, which actually has really great returns. We're shocked how strong they are, has essentially is a pool that's more balanced. It's meant for shorter term philanthropic giving. So if you're looking to distribute your funds in 5 years, let's say, and not hold them forever or longer, the midterm pool is a more conservative portfolio. That's why you can see it's not up as much as the others in the more recent periods of time, but it's generated really healthy returns. This shortfall you see over 5 years is mainly noise. Frankly, if you went to the actual inception of the pool, it's matched the benchmark, which is a little longer than 5 years now. We have a slightly different strategy than the benchmark, and that strategy differs because we have more in short-term bonds. So when interest rates are falling, which they've been doing a lot until recently, the pool will underperform by a little. But this is just to be clear, that pool is basically all in index funds. So let me just stop there, see if there's any quick questions about all that before I move on. Okay, I'll keep going. So one of the things that if I go back for a second, so pages like this are interesting, and we like to talk about this, and you can compare the numbers very easily. But the success from an investment perspective is kind of force equals mass times acceleration. So in this case, acceleration is the difference between your benchmark and your portfolio net of fees, and mass is the number of years that are talked about, because it's a multiplier effect. And so that's what this chart looks at, which is it takes the same numbers, long-term pool only. We didn't do the SR pool because it just made the graph too busy, but they were also very strong, just to be clear. And the long-term pool has a longer record, all pun intended. And the 45.2% return we saw earlier, this is the benchmark again, and then this is the CPI plus 5. But what we're doing with these other numbers, these bars that get bigger and bigger across the page, is we're doing the force equals mass times acceleration thing. We're just basically producing cumulative returns. So not per year like the prior page, but just multiply them out. And when you multiply them out, remember the gains of 1 year that stay in the portfolio get multiplied by the gains of next year. So the numbers just they don't exponentially grow, but they grow at a compounded rate. So what's interesting, if you look at this graph, is what you can see essentially is the way that advantage I showed you earlier starts to really, really add up. So let's just, for example, start with the easiest one here, the April 1, 2002. So 319% return is the cumulative return all those years for the pool. The custom market benchmark's 226 or 227 to round up. So go back for a second. If you don't, go back for a second. Wrong way, sorry. That's 7.8 and 6.4, which again looks like a nice difference, but when you look at it this way, it's not just a nice difference, it's an incredibly important difference. And that's why we do the things we do. Sometimes they cause us some short-term embarrassment when things aren't going the way the markets want them to go. But if we stick to a good discipline, they tend to work out in the end, as you started to see more recently. But this difference is massive. And it's even more important in the sense that for 15 years and for the April 2002 period, it was the difference between keeping up with our real objective, CPI plus 5, and not keeping up with it. And this spread is going to be the thing when we get back to just the preview of the insidious problem. The insidious problem is, just to put it right out there now, is over the next 10 years, how are you going to earn 8% or 7.5% per year. There's no easy way to get there, by the way. And that's why that's the one that scares us actually the most. So looking at the two pools, we talked about this earlier. I just wanted to kind of give you a graph to show this in terms of how they've differed in terms of performance. So what you're looking at here are rolling 5-year returns. So we go all the way back to the beginning of the SR pool, the socially responsible pools data. That's the orange line or the red line, depending on your screen color. The blue line is the long-term pool. And you can see this is that period on the left. And then when it's a 0 in the middle, that's how it's done compared to the 60-40 mix, which is just a different benchmark we're using. We're only using this benchmark so you can see the differences in the two pools. The benchmark's sort of irrelevant. So when the blue line is above the red line or orange line, the long-term pool's outperforming. To the right here, when you see the orange-red line above the blue line, the socially responsible pool is outperforming. But here what you can clearly see is the cyclicality of these things. And there was that period on the left where, again, the question was, why is the one pool doing better than the other? In the middle, we got kind of what we really love, which is they're both doing really well. They're both above 0 and they're both doing great. And then you get to this right-hand side of the page, which we didn't love at all, by the way. We're very happy to have the SR pool hang as tough as it did in this climate, which was really tricky. But the blue line, the long-term pool, did not hang as tough. It had a really rough period from late 2019 into mid-2020. This big rebound you see on the right is the payback for waiting it out a little bit here, and it continues to get better as we speak. So that's going to get back to where we want it to be. It's already back above the 60-40. It's above 0, and frankly, I expect, I don't know, a year from now, 3 years from now, 5 years from now, it'll do better than the social responsible pool, and then another 2 or 3 years later, the social responsible pool will do better again. And all we really want is for them both to be way above the line, above the 0 line. Then we're really happy. That's the ultimate goal here. So let's talk about the strategy. So later on, I'm going to talk a little about inflation and get into some of the macro factors that definitely affect markets and have an impact. But I also want to remind you that we don't get up in the morning and try to figure out what the economy is going to do. We don't get up in the morning and try to figure out what other investors are going to do. We just think that those things are impossible to know with any certainty and impossible to have an advantage. So what Vermont Community Foundation is doing is essentially playing the long game and thinking about, what are the things that we can get right much more often than we get them wrong, and how do we pursue those effectively on behalf of all of you and other donors of the foundation. And there are 3 simple rules. Rule 1 is we think long-term, and you'll see we put on this top bullet point, preserve purchasing power over 20+ year periods. That seems like a silly time horizon sometimes, and we definitely think about shorter periods too, but the reality is that we keep our eye on the ball, and that's the ball. And in April and May of 2020, this was really important because if you thought about it that way, you could make some assumptions, one of which being the pandemic will eventually end. And as long as we own businesses and assets that can survive a pandemic, which we'll talk about a little bit later, then we just need not worry too much, even though it was unbelievably difficult. The second point, I see some comments. I'm going to jump and stop in 1 second, I promise. The second point is that we didn't try to figure out what would happen next. It was really easy in March in 2020 to say, oh my gosh, the world's economy is literally shutting down. This is a horrifying, scary thing. There's no way this is going to get better quickly. And the reality is actually we're all still sitting on Zoom calls. I actually went to my first manager due diligence meeting. We can about a little bit later on Monday of this week, Tuesday, actually not on World Day, Tuesday. We hadn't been in an on-site meeting with a manager in 14 months. I hadn't seen people work for me in 14 months. And so, it's been bad. I know no one's going to argue that point, but the idea that we didn't know what the markets would do exactly was incredibly valuable too. And because they've done things that most people found surprising. And then last but not least, diversification really matters. And you have to be really, really thoughtful about how you do that and don't end up with what we call diversification, where you end up with just less return. But if you diversify effectively, you can end up with more return without more risk. So let me just see, I saw comments. I don't know if I can see the comments. So Debbie, can you see the comments?
Yes, so one question was, and I'm looking up the other one. Hold on, sorry, I just saw them and now they've dropped off. I'm looking up the percentages allocated between the long-term pool, mid-term pool, and SR, like of our portfolio, how much is in each pool. And I'm looking that up right now. I don't have it at the top of my head. And the question, Mike, that you can talk to while I'm looking that up is, can you give a specific example of an investment that's a long-term investment, but not in the category of socially responsible?
Yep. So the socially responsible pool basically is focused on only managers that have a strong ESG framework. And so they're very thoughtful about environmental, social, and governance risks. All the managers are thoughtful about it, but the socially responsible pool is much more likely to not hold certain investments because of the fact that they just don't have very good ratings and assessment, to be very clear, in those functions. But I'd also add, there's more to it. And I don't know if Dan wants to jump in here too, but sorry to put you on the spot, Dan, but the SR, social responsible pool, is also very closely aligned to a really specific set of values, a values framework that the foundation has established. And so it's got a lot more intentionality around that issue, whereas the long-term pool, which is not lacking in thought around the topic, is not as focused on these issues to the same degree. Dan, can I put you on the spot? Do you mind?
Not at all. Thanks for the question, Evie. I think in rough numbers, I'm going to let Deb tell me how wrong I am in a second. In rough numbers, the funds in the long-term pool are between, are roughly $200 million. The SR pool is going to be north of $100 million at this point. And I'm not quite sure, the midterm pool somewhere less, maybe 9 to 15 million overall. Deb can tell me if I'm in the ballpark. I think the interesting thing is that of new funds created at the foundation in the last 5 years, the overwhelming number have been opting into the SR pool rather than the long-term pool. We undertook a process to redesign our SR framework. It was in motion when I came on board, and we wrapped it up with Deb's leadership, working with Mike, to really orient both around the selection of managers who are able to present, strong likely returns, effective investment strategies, but also had robust ESG frameworks. And we also ranked those managers against, our sort of our look at the opportunity gap and the relationship between managers and the strategies of managers for community vitality over time. We have kind of a way of assessing the recommendations that Colonial brings to our investment committee for that pool around those things. It also leaned on, in the design of it, leaned on the 17 sustainable development goals that the United Nations had put out, many of which are actually intersectional with the opportunity gap frame that we rely on for our community impact objective. I think the other thing to bear in mind is that across all of the pools, there remains a really important 5% asset allocation to Vermont investment. It's really where, in terms of our impact investing, the most intentionality and energy goes from our management strategies, because those are investments that are actively at work in enterprises that are employing Vermonters, creating jobs and wealth in Vermont communities, and revitalizing downtowns, and hopefully shifting the economic circumstances in Vermont that in many cases make it be necessary over the long term. I hope that began to answer your question, and I'll kick it back to Mike.
Yeah.
Thank you,
And
Dan.
just to let you guys know, Dan, you are spot on the long-term pool, about 200 million, over 105 million in the SR pool, and our midterm pool is only at 3 million. And that's because it really is a shorter focus investment strategy, as Mike mentioned. It's a 5 to 7 years. So a lot of fund holders that are in that pool are there for a specific concrete time frame, not necessarily the long-term look that our other two pools are focusing on. I'm going to let Mike go back and continue. There's another question, but let's get back to the presentation, and then we'll hold that next question, because I think you may cover some of that in the next section.
Okay, great. Thank you, Deb, and thank you, Dan. Thank you for letting me put you on the spot that way. Here are the three pools in terms of the differences in their asset mix. So Dan just walked you through, and I was trying to as well, some of the differences in the philosophy behind the long-term pool and the socially responsible pool. There's also a difference in the asset mix, where you can see, first of all, the top category are all stock or equity buckets. 58.5% of the long-term pool is allocated to them, 60% of the socially responsible pool, and 47.5% of the midterm pool. And then the biggest differences are here under fixed income, where you see the long-term pool is actually less fixed income. That's one of the reasons it did not do as well in early 2020, not the only reason, but one of them. And the socially responsible has more, and not because we love fixed income much more there, but because at the bottom, where you can see they're just less, there are less, there's no opportunities that we could ever find in hedge funds that would really fit in a way that we'd find compelling enough. The ESG framework and the values alignment framework, the opportunity gap framework that Dan just described. So we don't own hedge funds in a socially responsible pool. And the private asset difference you can see there, that will converge over time. One of the exciting things about what Dan was just referring to is that the growth of the socially responsible pool is making it, really giving it an asset base that's more and more capable of supporting private investments. Private investments can be much more impactful on a global basis than public market investments can be in a pool like this one. And the other reason there's a difference is the socially responsible pool has grown so fast and it's newer that we haven't as much time to build that portfolio. So I would expect over time that the committee may decide, and Dan may decide to actually increase those weights and get them to converge closer to that 10% number. But that's the other difference you can see here. The final difference is the midterm pool, like I say, has a lot more bonds, and that's very intentional. And that's because bonds are less risky, they're less volatile. And when you have a shorter time horizon, you can't have as much money in the equity market. So we're big fans of long-term returns for equities at this point, but and we have no idea what the short term holds. And so that's why you have to be a little more cautious in the midterm pool. And as Dan just alluded to, each of the pools has a 5% target, which is very much what's there almost all the time in Vermont Investments, as Dan just described. So those are the differences in the pools. So I'm just going to walk you through quickly. Earlier on, we showed you returns that were, with the exception of 3 years in a long-term pool, but basically really both short and long-term returns for both pools that are above the benchmarks. And this gets to, a really big issue in the world today, which is that's an uncommon outcome. It's something that people just don't see that often. Most people would like to be in index funds for very good reasons because they tend to do better. In this case, that's not what's happened. And so I want to just talk about how we got there with the goal not to do any back padding here, but instead the goal to show you or give you some confidence that this is not a flash in the pan kind of thing. Obviously after 19 years, it probably isn't, but why don't we just talk about what's behind it? Because I think it's important. So first thing, there are 4 rules that we followed our firm to try to pick managers. And as Dan said, we come to the committee, they vet the ideas, we bring them the changes, we bring to them. Ultimately, that decision ends up in Dan's hands, but he uses the advice of both us and the committee to make decisions. But these are the rules. Rule 1, returns must always be accompanied by risk. So the first time anyone walks into our office and tells us they have great returns and no risk, I don't even know we'd let them in the office. That's just a bad joke. Everything has risk. And the question is, what are the risks and can we bear them? And do we think we'll get compensated for taking them? The second point, we must understand the strategy, know the key people, and avoid needless complexity. So sometimes people over-engineer things and make them too complicated. And we're not the most brilliant people in the universe, but if we can't understand what you're doing as an investor, then we're not interested. Very simple. And the other point, which I'd like to get back to, my earlier reference to being in someone's office 2 days ago, was a big deal. Like, you really can't get to know key people over Zoom. So we're anxious to get back on the road and do the work we used to do. The foundation employs managers on 4 continents right now, and we need to continue to grow the universe of people we look at, both in our continent, of course, and others. And so getting out there is really important, and knowing who we're dealing with. Third rule, no risk on the operational side. This is an area where you just can't take risk. There needs to be it's the Bernie Madoff question, right? There can't be fraud, there can't be theft, and there are ways to protect the foundation. And so we have a team that's currently 3 people, going back to 4 soon. That's all they do all day, is check on the operational soundness of the people that manage money for our clients, especially the Vermont Community Foundation, of course. And then last but not least, this is a forward-looking process. And I'm going to show you an example of that later and how that works. But basically, a lot of assessment of investments is done in a backward-looking way, which is how did the manager do compared to their benchmark, looking backward. And that can be helpful, but it can also be misleading. When a manager is struggling, you might see weak returns, but those might be just temporary and cyclical, and you don't want to jump away from them when that's happening. Sometimes when a manager is doing well, they're getting lucky, and you don't want to be investing with them. And so you have to try to know the difference. And that's why these first 2 rules are so important, and it ties into that last rule. So Debbie, should I stop again? Because I thought I saw some more questions popping up there.
Yeah.
So go ahead, Dan, and I'll jump in.
Yeah, I mean, I'll just respond to Robert Gay's question about Vermont Investments at 5%. So 20 years ago or so, our board, the board of directors of the Community Foundation, adopted a policy and a rule that said no less than 5% of our assets would be invested in Vermont to advance the mission of community vitality. Over time, as we've grown, that pool has grown. The strategy has evolved from relatively passive investments through intermediaries like the Land Trust, Vermont Housing Finance Agency, housing trusts, to more active direct investments. So right now we hold it's almost a $15 million portfolio with a number of those intermediary investments, also some direct venture and enterprise investments with supporting key employers in regions where the economy is challenged, supporting downtown revitalization projects, complementing in some ways our grant making strategies in certain places in an effort to generate community sort of comprehensive strategy for community redevelopment and momentum. So, think of Mamava. We're invested in that both through Fresh Tracks Capital, but also in a sidecar investment in Mamava as a women-owned, fast-growing enterprise in Burlington. High Mowing Seeds in Wolcott, organic seed manufacturer producer who was struggling, but was the largest employer in the four rural communities around Wolcott. And then obviously, when everybody was asked to stay home for the spring planting season, their online and catalog sales shot through the roof. So we were able to help capitalize that growth and had positioned them in terms of their investments in point of sale, those kinds of things, to actually be ready to grow quickly. So it's a one more tool in terms of how we think about the role of the community foundation and in terms of long-term community vitality. I would say also, this is another point relative to how the different pools are capitalized, the SR pool. Over the last year and a half, Deb and her team, David Morrissey, with David Morrissey, have migrated all of the discretionary assets of the community foundation. So over time, we've, through the generosity of various fund holders and funders, have generated, I think it's around $35–40 million worth of discretionary funds that run our grant making, our discretionary grant making. We've migrated all of those from the long-term pool into the SR pool, because we think about from the grant making side all the way over to the long-term pool asset management side. We think about assets and communities impact collectively. So the further more assets we can move further along the spectrum of community impact, at least known community impact, understood community impact, and then directly sought community impact, we can credibly and articulately describe the way our assets are affecting Vermont communities as a philanthropy. So that drove in addition to the new funds into the SR pool, that migration of the discretionary assets to the SR pool helped drive that growth to where it is today. So that's not going to be less of our work going forward. It will only increase. Mm-hmm. I hope that answered the question, and I hope it also made sense.
That's covered all the chats that I saw. It's time, Mike, so you can jump back in.
Okay, great. Yeah, thank you, Dan. Thanks, Debbie. So I'm not going to run through this, obviously, but this is just to give you a sense of where the process starts. There's a lot of things to look at in investments, and so it's not, hey, oh, this sounds good. There's a lot of work that goes into everything, and this is leaving off a ton of stuff. So this is just the things that when the committee is looking at our detailed reports on investments that are being proposed, this is amongst the things they're reading about and asking questions about. So now let's switch to the interesting part of this. Not that the rest that was interesting, but the interesting part on a go-forward basis for the markets. Excuse me. It's just interesting for the markets, not for everything else. So three things. One is this is actually the best of times if you are a patient investor who is willing to think differently than other people. I think that's a really important point. The second point, if you don't actually understand the dimensionality of investing, which is there is both what you're buying and what you're paying for it, there's a real problem that you might be facing going down the road. And last but not least, market speculation. We see it everywhere. It's just incredible to watch. As somebody in this industry a long time, I remember last time markets felt a little bit like this, which was 2000. I think today's even more interesting and more speculative in some ways, and it's just amazing to watch. And I'm not certainly pointing fingers at any specific investments, but unfortunately, speculation always ends the same way. Human behavior is always the same in a lot of ways, and so that's unfortunate. But we'll see what happens with that. But this category or combination of things has created a very difficult long-term investment climate. One, because again, the speculation will have to stop at some point. It'll stop without warning, and it will be ugly, just to be clear. But there's a bigger problem. We can just avoid that and sidestep it. So you won't be hearing a lot about our crypto investments. We don't have any in the portfolio or anything of that kind, and we're not going to be buying any GameStop anytime soon, I can assure you. But the fact is, though, that there's a bigger problem, as I mentioned. And that is the valuations of stocks. So I don't want to put everyone to sleep here, but let me just point out something. As a long-term investor, there are two ways that you can lose money. One is you can buy terrible businesses, and they can either go bankrupt or just deteriorate over time, and you're not going to make any money as an investor. The second is the one that really gets people, though, which is you can buy good businesses or even great businesses and pay too much for them. And that's something that is really hard to wrap your head around, because what the value of a business isn't obvious. And so you get into long debates, and professional investors and amateur investors to some degree do or should spend their time trying to figure out what is this business actually worth. And a business has a value based on what economics it can generate for its shareholders. And it's really that simple. It's not that complicated. The problem is, what is that is a very hard calculation. So that's what we call the earnings. We'll use the word earnings to describe what a business is delivering for shareholders. And what you're looking at on this page is something called the Shiller ratio. So the Shiller ratio, Bob Shiller is a professor at Yale who came up with this idea that he was going to essentially try to get rid of some of the noise around what the markets are pricing or how markets are pricing earnings. And so that's what this, just to give you the details for a minute, the Shiller ratio essentially takes the last 10 years earnings from the S&P 500 in this case, inflates them, so you take out the impact of inflation on them, and then creates a ratio, price of the index divided by the 10-year average earnings. So he's very generous, Bob, and what he did is you can go on his website and you can actually see every Shiller ratio every month all the way back to the 1860s, I think it is. And then you can figure out and he has the ratios right there. So we created all these buckets on the left-hand side of the screen, which is essentially the Shiller ratio over all these different little categories. The second column is the number of times since the 1860s, I think it is, that the Shiller ratio is in each of those categories. There were 1,565 monthly observations, and you can see that column. Then the next three columns, what they do is answer the question that everybody wants to know the answer to, which is what's the market going to do next? So what we did is we said, let's take every single Shiller ratio and calculate the next 10 years returns. So again, Shiller ratio on point A, 10 years later, what did the S&P 500 deliver? So look at the right-hand side of the page, the very last column. That's the median, which is the middle of the distribution. And you can see there's actually, if you're an investment person, you see a very predictable outcome, which is the higher the Shiller ratio, the lower the future return. The lower the Shiller ratio, the higher the future return. Very simple. And it's, people sometimes, that's not the way we're wired to think, because we like high prices. High prices make us feel wealthier. But the reality is that high prices are bad for us, just in terms of what the long-term future returns look like. And the analogy that I always try to throw out there is, it's sort of like, if you think about you're buying something, an actual product or service, you want to pay less for it. In investing, people don't seem to want to do that, but nevertheless, that's the same logic applies. You get more value for your money if you pay less for something, all else being equal. So now let's get to the problem of today. The orange shaded area is where the Shiller ratio is right now. And you can see we put down here the May 28th, because that's when I produced the slides. I don't think it's that much different today. Shiller ratio is 37.3. So there's a few things that are disturbing about this. First of all, it's at the top of the graph. That's a problem. And the second thing is the Shiller ratio, let's be generous and say it was 35, which is right at the bottom of that range, has only been this high 34 times in history. So that's generally not a good sign. If you look at the columns to the right, the best forward 10-year return from this group of 13 observations was 4.7% per year. That's the best. The worst was a negative return per year, keep that in mind, and the median was 2.6%. So this is our problem. Let's get back to 7 to 8% returns. if you're only going to get 2.6 out of the S&P, or let's be generous, you get 4. How you can get to a 7% return, particularly if you also own bonds, which, as you all know, have very low interest rates today, so they're not going to generate big returns. You'll hopefully get 1 or 2% out of your bond portfolio. And so this is a huge problem, particularly because a lot of capital, not the foundation's capital, but a lot of capital is invested in the S&P 500 and or bonds. And this is a real big problem. Now, you can certainly say, hey, maybe this time will be different. We could have a conversation about that if you want. But the reality is that we don't like making decisions on behalf of Vermont, perhaps on the donors, perhaps on the foundation, that are based on this time is going to be different. That is a really dangerous place to go. We'd rather, again, I said earlier, stick to things that we actually have pretty high confidence will work. And again, defying history isn't on that list, just to be clear. So this is a really, really disconcerting problem for us that we have to really think about as investors. And if we go to the next slide, here's the other problem, which is starting to emerge in the markets today, which is inflation seems to be coming back. I will tell you, we're a little skeptical about how much of a problem this really is. We still live in a very complex world where I think there's a lot of deflationary forces, and inflation is a mindset. It's not just the numbers that the BLS reports, but you can see inflation in its most recent reporting is up to 5.2%. So this is all items excluding housing or shelter. And you can see it's pretty high compared to the last, really, this is about 14 years. And the question, of course, for everybody will be, is this persistent or is it not persistent? And that's a question none of us can answer. Again, we're not incredibly worried about it, but who knows? And we're not going to change strategy regardless of whether we're worried or not worried about it. We have a strategy built on basically hanging tough, and I'll show you why, regardless of what inflation does, unless it goes through the roof and stays there on a sustained basis, which will create a different set of issues for us to think about. But my point is that this is what started to get the market to shift towards something that looks like the price of securities matters. And that gets us to the next slide. So this graph kind of goes right to the eye of the storm, which is, it's the perfect storm. It's the story stocks, to some degree, the story sector of the last 6 months. So these are what we call, basically, these are software businesses. Software as a service is the commonly used term today. And these are the darlings and have been the darlings of the market. And if you own these, you've been really happy recently. And I will say the Vermont Community Foundation does own, not these specific names anymore, but it has owned some of them over time, and was very happy with them. But nevertheless, let's take a look what this is. So this is another way of thinking about what's going on. The blue line are the average, let's just call them valuations of these companies. So if you want to talk about the details, we can, but these are the average valuations, and these are not like the Shiller ratios, different type of valuations, just to be clear. So don't try to compare those numbers, but you can see, if you look at the far left-hand side of the page, which was the beginning of 2019, the market was pricing these 10 businesses that we've shown here at the bottom in the footnote at about 8 times was the ratio. By the time we got to basically the peak, which was essentially in February of this year, the market was pricing these at almost 22 times the same measure. So essentially the market essentially tripled what it was willing to pay for things. So let's think about that. The story you hear in these companies is they're huge, quote unquote, winners in a world where technology is being adopted more quickly. The pandemic has triggered such a change, all true. But the fact is, the economic output of these businesses did not triple. And the market just was willing to pay triple for them. And that is really problematic in the sense that that's a lot of optimism in the prices. And it's usually gets back to my earlier point, the easiest way to lose money is own good investments, but pay too much for them. Now, I'm not saying that these investments are too expensive today, but they could be. They're certainly a lot more expensive than they were a year or two ago, and that should be disconcerting for people. Now, the orange line we're showing you here is meant to kind of indicate what the relationship is in terms of this and interest rates. And these names tend to be much more susceptible to reality hitting or people being less optimistic about them as interest rates rise. So if interest rates got anywhere back up near that 2.5% to 3% level, what happens to the values of these companies? In theory, some really bad things do. And the only reason we bring this up is because this is a risk we're not willing to bear. We're not willing to own things on the hope that people will continue to pay very, very high prices for them. We'd rather own things that people don't understand. So some of these might be in that group, or things that people don't want to pay much for, because that gives us a margin of safety, that gives us protection against long-term problems in the portfolio. Because again, we'll tolerate, we hate it, We'll tolerate a year or two of bad performance because we don't want to own the high flyers, but we will not tolerate a 10-year run of bad performance where we don't achieve CPI plus spending, because that's the disaster scenario. That's what should keep everyone up at night, not whether we did a little worse than an index over a short period of time. So when you think about the speculation, you think about some of the valuation problems, you think about interest rates rising, which by the way would be mostly good. What do you think about? And one thought is maybe we should become more defensive. And that's something that we don't do here. And we don't do it for two reasons. One is because there's plenty of really exciting things to own right now. I wouldn't put those 10 software businesses on that list, but there are thousands and thousands of really interesting securities out there that you can own at very good prices today, believe it or not. And the second thing we worry about is that market timing doesn't work. We have no idea what the short-term returns will be for the markets. We never will. We have never had any of that skill set. We never will own that skill set. And what we stay focused on are these long-term goals, and not owning assets that can generate good returns is inconsistent with our long-term goals. So that's why we're never going to do this. But this chart is just meant to give you a really interesting perspective on how risky it is to try to be clever. So this chart looks at basically the S&P 500's annual growth rate from 1995 to April 30th of this year. And you can see if you look at that first bar, it returned 8.8% per year over that period of time. If you went back to my earlier chart, that's one of the problems though, is we don't think it's going to do 8.8% per year going forward. We think it's going to do more like 3, but nevertheless, put that aside for a minute. But here's what gets amazing. Look what happens if if you're just the worst timer in the world and you essentially miss just the 10 best days, 10 days. I didn't count up the number of days here, but that's a lot of days between 1995 and 2021. If you miss just the best 10 days, you've lost 3.2% per year of your returns and taken a good return and made it into a pretty mediocre return. And of course, if you somehow managed to miss the best 50, I know that's ridiculous, but if you did, you changed an 8.8% return per year into a negative 1.3% return per year. So this is why that second rule I showed you earlier is really important. This is why in April of 2020, we didn't have a conversation with the Vermont Community Foundation about going to cash because it's inconsistent with our goals, it's inconsistent with our strategy, and we know for a fact that we have no idea what implications it'll have, except for there's a good chance it's going to hurt us. And so this is why we don't do that either. So one more last thing, and then I would love to take any other questions you have, which as I mentioned, so how are we going to do better than the indexes? How are we going to, what skill set does the Community Foundation need? What skill set does, I know Dan possesses, so I'm not going to say does he need, he already has it. But what do we need to succeed on a go forward basis, especially if we're going to not make a lot of money on bonds? We can't just buy the S&P 500 and let it work for us in a meaningful way. What do we do? And the answer is we diversify. We take advantage of the inconsistencies in market pricing today, which if you went back, and I didn't want to do too many slides there, but there's a slide we've shown earlier where the S&P might be very expensive today, but there are tons of really inexpensive stocks out there, particularly in the value parts of the world, the cyclical parts of the world, and where we can find inconsistencies in price regardless of where they are. There's a lot of that out there right now. So there's a lot of good things. But the skill that you have to possess, which is the one that is above all, is patience. And patience and a little bit of faith that the people making decisions in the portfolio are being thoughtful about them and not just doing things willy-nilly. And so this example, this is a manager that the foundation hired back in 2016. And the firm's name is Barker Parsham Fund. This is a classic Vermont Community Foundation manager. And since it's a small firm, almost nobody has ever heard of them. They only have really 5 limited partners, including some of our clients like the Vermont Community Foundation that are invested. And he owns a very concentrated portfolio of stocks. It's a perfect example of where I've always been very grateful to the committee and to Dan for trusting us as much as they do, because this is a very, very off the run kind of weird investment. We don't put too much money in it, of course, but it's a very interesting investment. I use it because it's so dramatic here. So what you're looking at on this chart is the blue line is the Barker Partnership Fund's rolling 12-month return compared to global stocks. So it's a global stock manager, although most of his names are in the UK. So the blue line is that. So when it's below 0, he's underperformed the index over that period of time. When it's above 0, he's outperformed the index. We gave you a couple of quick kind of points of reference, which is the S&P 500 is the yellow line. Again, same thing. When it's below the index, it's underperforming. When it's above, it's outperforming. And then the Russell Top 200 Growth Index, which is a great example. These are kind of the darling software businesses plus other high growth businesses as well. And you can see what that looks like. So the reason I just wanted you to see this graph and why I've reused the word patience is from 2016 all the way until basically March of 2020, he had good years. He's good years where he's above the index, bad years where he's below the index. It was basically a whole bunch of nothing. You put it all together, he was just hanging around the index, and it was really for 4 or 5 years. And a lot of people would look at that and say, you know, why do we own a manager who is, you know, is indifferent as this guy is, and he's just done nothing for us. And then, of course, you can see, boom, the pandemic hits. And he did some brilliant things, leaned into companies that were, in his view, clearly going to be big winners. One of them, just to give you an example, was a company in the UK called ASOS. He owned Zillow. He's owned names of that kind of ilk. And then what you see here on the right-hand side of the page is he's actually the most recent measurement. He's 120% above the index. So after years of 120% in 1 year, again, above the index. So if the index is up 20, he's up 140, just to give you the numbers. That's what we're talking about in terms of order of magnitude. Again, I bring this example up because it's a perfect example of how patience works and how it's not easy to do, though, when you look at these numbers. And it looks easy here, but it's not. And I'll give you one more quick example. We don't have a slide. We have another manager that invests in Japan as an activist, and they've really, really struggled over the last 4 years. They've had both feast and famine, and the committee and Dan have been extremely patient there, and that has been very tough to do, I have to tell you. And they're up 70% so far in 2021, which, you know, is something the committee is going to talk about today. My point is, it's the same story over and over again, which is own people who are doing very different things from one another, and where we can be patient because we have faith in what they're doing, and we obviously they have to prove themselves to us over different periods of time. So last but not least, so here's the formula. Let's stick to things where we can have success. 1 is valuation, I mentioned earlier. 2 is diversification, and 3 is patient. Endowments have, and long-term investors have, an advantage, and that advantage is about time. We can wait. We don't need to be right every minute of time. We don't need to have a good month every month. We just need to have good 10-year periods, and so that's what we focus on. The question earlier about the amount of assets was a really savvy question, because that matters. When you have scale, and, you know, Dan and Debbie talked about the 200 million in the long-term pool, the 100 million in growing in the SR pool, scale gives you more and more options as an investor. Stability gives you a lot of options as an investor. And I mentioned the time horizon before. And I want to be clear, we actually love index funds. We think the 90% of the active management community will continue to fail to beat indexes and then some. But there are that 10%, and the foundation has managed over the years to find enough of those to generate outperformance compared to indexes. And we want to continue to do that, of course. But if we can't find great investors, we are very happy to own the index, and we will always feel that way. And then last but not least, this is the last point I want to make. While it's scary to think about speculation unwinding in the market, it's scary to think about interest rates driving markets into the ground, maybe in the short term, rising interest rates. But the fact is that the more volatile markets get, the more difficult things get, that really increases our advantage. And that's where we get kind of both fearful and greedy at the same time. Not Dan, just me. And so the idea is that we know that when things look rough, that a lot of opportunities are being created. So, you know, we're not wishing for ill tidings to anybody, but if things are going to be bad out there, we know the foundation has some really big advantages that give us the chance to generate outsized returns like you've seen more recently. So I'm going to stop there. I appreciate all the great questions so far. And if there are others, I think we have some time still, and I'd be happy to try, or Dan or Debbie as well. Or
Mike, one quick question just for clarification. One of the participants wanted to know if the Barker funds are in the long-term SR pool, what pool they're in. I believe they're in the long-term pool.
That is correct, Debbie. They are in the long-term pool.
Okay. With that, are there any questions that people want to jump in and ask Mike? You don't have to use the chat. You can just ask right away, straight away.
Deb, we'll be posting the deck and the transcript of the call on our website, right?
Yes, the
always
deck
do
should have been, the deck should have been in the attachment, but if not, they'll all be posted to our website. If you just Google like Vermont Community Foundation investments, you can go right to that section. And if you have trouble, either reach out to me or Kim.
There are no questions. I'm going to start cold calling people. Look out, Bruce, Jake.
There has to be questions. It's an exciting time. No questions. Mike, you did a job. You just blew everyone's mind away with all the different thoughts you have here. And I appreciate taking the time to kind of, even for us that sit in the investment committee, hearing this information, making sure we're dotting our I's, crossing our T's, holding true to our strategy overall, as you've said, it has helped the community foundation. And it's not the community foundation that helps, it helps our fund holders that have that endowment, that long-term interest, to have the resources available to make the grants and have an impact in Vermont, which is our ultimate goal. So if there's no questions, I'll pause slightly. Seems like there's no questions. Feel free to reach out to us, and these will be posted to the website shortly, as well as all the past calls that we have with the slide decks as well for you to review if you'd like to. So with that, I want to thank everyone for joining the call, and we look forward to seeing you at the next call, which I believe is going to be in the early part of September. Until then, I hope you have a great summer and you get to have outside time and see friends and family that you haven't seen in a while. Take care, everybody. Thank you so much.